We got another warning from the legendary investor Michael Burry. But as usual, he keeps warning, but very few people listen. And this is why I believe he named his Twitter Cassandra BC. Now, many people say that BC stands before crash, but I believe BC stands for broken clock, because this is what many people call him. Mainly because he warned about some things in the past and didn't happen. So therefore, they call him a broken clock. And I get comments all the time, people saying, yeah, if you warn about a recession or a market crash every year for 10 years, you eventually end up being right. And what people miss is that Michael Burry and others can only point out the problem. But how long it takes to play out, he cannot really do it. No one can time those things. So he can only point out the problem, but the timing, you just can't time it. But again, I'm not like other people. I like to listen to people who are smarter than I am and learn from them, especially from a legend like Michael Burry. So I decided to comment on this tweet, which is very, very interesting. And again, many channels on YouTube comment on Michael Burry, but they were commenting on Cassie Wood last year, and very few of them are actually holding a large cash position or have any short or put positions in the stock market to play this entire market crash. But as I said before, I have skin in the game and I'm personally positioned around this whole thing. So this is what Michael Burry said. He said, adjusted for inflation, 2022 first half, S&P down 25 to 26%, Nasdaq down 35%, and Bitcoin down around 65%. That was multiple compression. Next up, earnings compression, so maybe halfway there. And I do agree with Michael Burry around the multiple compression, although I believe there are many stocks who are still overvalued, something like Apple. Again, I remember buying Apple in 2018 around the 14 or 15 PE. And now Apple's PE has come down, but it's still over 22. And I believe this is high for Apple. I believe between 18 or 20 is something fair for Apple. Again, Apple is making more money, but it's not making that much money. And Disney stock is the same story. And there are many of those stocks who have a long way down to go in terms of multiple compression. But in terms of the earnings compression, this is very interesting. And it's something I've been talking about. Because if you look at the S&P 500's EPS estimate and Morgan Stanley made their own estimate, you could see the big difference between Morgan Stanley's estimate and the actual estimate. But I don't know about you, but I personally believe that even Morgan Stanley's estimate is even on the optimistic side for the EPS. I think after the second quarter on earnings season, which is coming in this August, I believe this is when the analysts are gonna downgrade the EPS for the entire S&P 500. And then this forward PE, which you've been looking at, and I've been warning, the forward PE doesn't tell the story, because those earnings, they cannot be just the same. I'm sure they're going to be revised down. Therefore, this forward PE is going to be much higher than what you were looking at 2 or 3 weeks ago. But in terms of earnings compression, there are two things which I believe are going to contribute to this compression. The first one is cooling consumer spending, and the second one is more around margins compression in the companies themselves. Now, the first one, cooling consumer spending, points to further economic slowdown. The latest one, the household spending in May, it rose at the slowest rate this year, only at 0.2. Now, before, at the beginning of the year, it was rising around 0.6. So it went from 0.6 to 0.2. And this is a big slowdown, and it's going to slow down even more. Why? Mainly the Fed was talking about, strong consumer spending and the economy is strong. But it's all credit. It's all borrowed money. Because looking at consumer credit, it's the highest in history of the United States, the highest ever. Now, how can you say this is a strong consumer spending? I don't think consumers are spending and borrowing money because they're so confident. They are worried. And we can see it in terms of the sentiment and what they're saying on the internet. But the main reason they're borrowing over $52 billion in the last quarter was because they cannot make ends meet on their own wages. And this is what leads me to the second point, which is margin compressions for the companies themselves. If you look at this chart which I showed before, this is the CPI in the yellow, and the blue one is the average hourly earnings. And you can see the big gap between the two. Now, because consumers are earning less money than inflation, they're going to spend less, which is going to lead to the earnings compression. But the second one is more on labor cost inflation. This is when those people are going to ask for raises. Many of them get them close to the end of the year. Whenever they ask for those raises, this is going to raise the cost for the company and it's going to compress their margins even more. So this is why I agree with Michael Burry that we may be halfway there. Again, my personal target on the S&P 500 is pretty much around 3,000 to 3,200. We could go as low as 2,500. I would not be surprised at all. But I believe, under 3,500 is pretty much most likely going to happen. And 3,000 to 3,200, this is my main target. It can go lower, but this is my main personal target. And I believe this is an amazing opportunity to buy, especially anywhere under 3,500, which is why I've been warning people that it's gonna get worse before it gets better. And you must be prepared now before it's too late. So this was my thoughts around the recent tweet with Michael Burry. I hope you enjoyed it. If you liked it, please press the like button and maybe consider subscribing. So I hope to see you in another video.